All right.
Hello, everyone. Welcome to yet another Viterbi Startup Garage Oceanside chat. We are very fortunate today to have an investor, Dalton Wright, who hails from Kickstart Fund. A little bit about Dalton. He focuses on early stage technology startups in the Western United States and in Mexico. His funds have raised nearly 400 million USD, and he's backed over 150 technology startups. The startups that traditionally he's funded are B2B SaaS, marketplace, data, networks and analytics, machine learning, AI and blockchain, and health and IT. So basically all of them. And he has a wealth of understanding and research in terms of how investments are made, and he's very interested in the future of technology. There isn't a startup that he wouldn't consider, I'm sure, at least a little bit. So I'm going to go ahead and pass the mic over to Dalton. Go ahead and take it from there.
Great. Thanks, Arcelia. And I'm really happy to be here with you all. Thanks for allowing me to speak for a few minutes today. I did come at this as more of a chat format. So I hope that some of you would like to ask questions, and feel free to jump in. And I really hope this is helpful to some of you as you build your businesses. I think I'll structure this. I'll talk a little, just introduce myself a little bit and talk about how I got into the industry that I'm in, and then describe what I've seen happen at the seed stage since I've been in business, where we're at now, and where I see it changing. I think this is a pretty distinct time, a moment in time right now, as the venture business model is being challenged and reinvented in a lot of exciting ways and disruptive ways to us. I think our business is going to be impacted pretty fundamentally over the next few years by some of the changes that I see happening. But just by way of quick introduction, so I'm from Utah originally, and I didn't know anything about venture capital when I went to college. I went to the University of Utah. I thought I was going to be a lawyer. I wanted to have some sort of prestige, maybe. I wanted to have a real job. I wanted to have a good job, and I had no idea about entrepreneurship, venture capital. And I was lucky to join a student-run venture fund called University Venture Fund. It was really the first of its kind, very early, trained me in the due diligence process, how to look at investment opportunities. And our model was, we would partner with established venture funds. We would help them do basic research on the companies that they were looking at. And in exchange, they would let us co-invest with them in some of the investment opportunities that we were looking at. And that's where I first really kind of fell in love with the possibility of venture capital, the potential of scalable tech companies to solve big, meaningful problems at a global scale. I just fell in love with the pace of venture capital and tech startups. When I was starting my career, I felt like I had to work all the way until age 65 before I could look back and see what impact maybe I had with my efforts. And I saw companies back then that were, changing markets in 5 to 10 years. I was so blown away by the pace that it just pulled me in. So I started a company as an undergrad student, started what we hoped would be YouTube before YouTube existed. And obviously we didn't build YouTube. Otherwise I probably have a very different story to share here. But that was my first attempt at a startup, and, a lot of lessons that I could share for a different day. But the biggest lesson was I just learned how hard it is, So I come at this understanding the sacrifice that entrepreneurs make, how it's thankless, it's you're not in the spotlight most of the time, and you're just grinding it out. And in the early days, most people don't even care about what you're doing, and it's everything to you. And so I have a lot of empathy for entrepreneurs and a lot of respect for entrepreneurs from those early experiences that I had trying to start a company, just really understanding and learning firsthand how difficult it is. So I was lucky, though, to get into, after my company essentially failed, I felt like a failure as an entrepreneur, and I wanted to figure out how to be a better entrepreneur. And so I thought, well, maybe I could go back and get a job with a venture fund. I wanted to be at the heart of the energy where deals are happening. I wanted to be surrounded by the very best entrepreneurs. And I thought that a venture fund would be an interesting place to do that. And so I was lucky to get my foot in the door with a group that I worked with as a student at the University Venture Fund, and started to get into the industry. And around that time, Kickstart launched. So this was back in 2008. There were no seed funds in Utah at the time. In fact, there were very few seed funds in the nation. Most venture capitalists were Series A and beyond investors, meaning they were doing $5 million rounds in companies that already had really credible teams, proven executives on board. it was hard to raise money if you were just a no-name first-time founder. Who would you go to? So, and back then, if were it not for Kickstart launching to be the first seed stage in our region, if you were a first-time founder, you were raising from angel investors, trying to pull together a syndicate. And that was really, really hard work. I mean, you were talking to hundreds of angels and you're trying to convince them to write $25,000 checks. You're trying to raise $500,000 and you just have endless conversations, and it's like herding cats. So when Kickstart came to market, we wanted to create fair seed terms. So previously we saw angels putting like personal guarantees into the terms. So if you were an entrepreneur, you know, your home was on the line if this didn't work out, right? You're securing your investment with your own equity in your home. That, you know, it wasn't that long ago, you know, when that was going on. You know, I guess now it's been 20 years, doesn't feel like that long ago, but fortunately that's gone away. And part of the reason for that was that Kickstart in our region helped establish clean, normal seed terms that follow-on investors out of the Bay Area could trust and get involved with when they found a company in Utah that they liked, knowing that if Kickstart was behind it, that it looked like a traditional venture-backed company and there were no weird terms built into it. And over the years, we've seen our ecosystem really take off. You know, I know that I don't want to make this a Utah-centric conversation at all, but Utah is an interesting case study where when we started, there were no seed funds, and we raised an $8 million fund back in 2008, first-time fund from a lot of angels and a couple of institutions. Now we have over 300 million under management. Our current fund is $110 million, and I won't talk about future fundraisers for SEC reasons. But things are going very, very well. And part of that is that Utah is producing unicorns at an incredible rate, something on the order of 1 to 2 per year. And, you know, the expectations for what these companies can do has only gone up. So it's a very exciting time for us to see what's happened in our ecosystem. And now with COVID and the pandemic and the remote work, we're investing in companies that are, you know, dispersed throughout the Western United States. I did take a little bit of a break from Kickstart after I helped get it going. I went down to Mexico. I spent a number of years in northern Mexico raising the first early stage tech fund. It's called Alta Ventures Mexico. It's a $70 million fund. In fact, yesterday we announced our first significant exit. We sold a company called Technisys to SoFi for over $1 billion, and that'll return Alta Ventures Fund 1. So my experience, you know, I went down to Mexico, helped create the venture capital category in the country. I came back to do grad school and then came to Utah, returned to Utah in 2014 to raise Fund 3, 4, and 5 for Kickstart. And as Arcelia mentioned, we've invested in over 150 companies to date, all of them at the seed stage. We go as early as anybody. We'll invest pre-product, pre-revenue, and we invest in great founders going after big ideas. And out of our current fund, our check size is, you know, between $500,000 and $3-4 million is where we're investing. So that's my kind of quick story on what I've done and how I got to this point and why I was drawn to venture capital. My passion for venture capital hasn't subsided over the years, which I think is really, really great. And it's being reinvigorated by a lot of the things that I'm seeing in Web3 and new investment strategies that are coming online enabled by new technologies. So, you know, most of our investments historically have been B2B SaaS companies, marketplaces, and we were generalist seed stage investors. And at this point, my primary focus, my partners are still focused on those categories. My primary focus is on AI, Web3, and, you know, to a certain extent, I'm moving into longevity as well. So those are kind of investment categories that I'm really intrigued by right now. So I want to talk a little bit about how our industry has changed. So when we first got started, if you think about what a venture capital round was back in the early 2000s, if you were a great entrepreneur or executive and you had a reputation, you had a great team with a big idea, you would raise $5 million. And with that money, you'd buy hardware, you'd buy software licenses to put on that hardware, and you'd spend a couple $1 million just getting your development environment set up so that you could then start coding your product. And a lot of the product that you were developing, you were going to deploy as an on-prem solution to enterprises. That was kind of what you were looking for. And so, you know, unless you already had clout, it was very, very difficult to raise funding because that barrier was so high. It's $5 million just to get in the game. And what's happened since then is we've seen this dramatic fall in what it costs to start a company, right? You've all seen this, that, you don't have to buy your own hardware anymore. Amazon provides it on a subscription basis, and it's infinitely scalable based off of your needs. You have endless SaaS solutions that you can turn to. In the past, you were writing your own CRM. You were everything that you needed to run your business. You were doing a lot of your own development in-house to support your business. And now you just choose best of breed across the board, and you pay a licensing fee, subscription, and you can just build your business that way. So it means that the capital requirements to start a company have dropped for the software business. I don't think capital requirements have dropped significantly to, put rockets up, although Elon's done something about that. Biotech still very capital intensive. There are some categories that are still incredibly capital efficient or intensive, but what we've seen is that for software businesses, that the barriers and the costs have really come down. And so it means that this has been the proliferation of startup activity that we've all participated in. And that's really exciting to me, because I love the increased accessibility. I love the underdog stories. I love the founder that comes out of nowhere and builds an iconic company. I love immigrant stories. And I think this is all being enabled by more accessibility for funding and the components of building startups. And I'll get into a little bit of why I think Web3 is interesting a little bit towards the end, and what it means for venture. But I think the barriers to starting scalable global technology companies have just dropped again another order of magnitude. And so my career so far, I've seen those costs come way down. So all of a sudden we have one company that's worth, $3 billion now, that they got their first product built for $10,000, right? When we first invested, they put $10,000 into developing an MVP, and now it's a multi-billion-dollar company. That was unheard of just 15 years ago. And I think this is going to happen again because of the composability of blockchain components. And so it's really exciting time to be an entrepreneur. And I think that the sky's the limit for what companies are going to be able to accomplish with this new foundation that they're able to build on. So just a little bit about, how, and I'll provide some definitions. So when I prepare for this, I don't mean to speak down and go too basic. At the same time, I don't want to be, assume that everybody knows the terminology that I'm talking about. And so I'll just provide some really quick descriptions of the types of investors who participate in the early stages, and what classifies them and characterize them as such. So you all have probably heard of angel investors. And angel investors are individuals who invest their own money in early startups. And so it could be a high net worth individual, it could be a family that has money, could be an entrepreneur who made money on an exit, and now they just want to invest in other startups. Those are angel investors. And AngelList is a crowdfunding platform, has really pulled in a lot of the retail angel investors into new investment structures and syndicates that didn't exist previously. So angels have always, as long as I've been in the business, have been around writing checks. And they're an important part of an ecosystem, but they weren't able to organize the way that they're organized now. Historically, angel networks were regionally constrained. So, Park City here in Utah has an interesting angel network. I'm sure you have angel networks in your own communities that you can think of that are geographically defined. That this is the, San Diego angel network or whatever it is. And what we're seeing now is that angels are able to coordinate on investment opportunities all over the world with angels that they've never met before. They're able to invest outside of their region, and they're able to do it in a way that's really seamless and easy to get involved with through angel syndicates and other crowdfunding networks. So those are angels. Venture capitalists manage other people's money. We also invest our own money into these venture funds, but primarily the capital that we manage is not our own. We raise funds that are closed-end funds, and it takes us 6 to 12 months to raise a fund typically. And then once we're closed, we're investing out of that fund. And so there's fundraising cycles that we go through. Then we stop fundraising, and then we were investing for a period of time into companies. And what we've seen change recently, this is a very recent innovation, is this new concept, new structure called rolling funds. So rolling funds are now enabling, influencers people with social media followings, people who have interesting networks and expertise, but they've never managed funds before. They didn't come up in the venture capital industry. They didn't work as associates and senior associates and principals in venture funds, and they're now raising their own venture fund. So it's really that this is somewhat unheard of before, is that you can go from having never been in venture capital before to now running your own venture fund. And rolling funds are enabling that. So a rolling fund is, see, how much background should I give here? We don't, when venture capitalists raise capital, we don't take out an advertisement in the Wall Street Journal and say, hey, there's this new venture fund coming together. Here's how much we're raising. Let me know if you're interested. That would constitute a public offering, and we would be in trouble with the SEC. So venture funds raise from accredited investors, and they raise only from investors that they already have a relationship with, or they have a private connection to. We can't, tweet out, hey, Kickstart's raising a new fund, who wants in? We would immediately have problems with the regulators if we did that. What's changed for these rolling funds is they've made this slight adjustment to the exemptions to the SEC rules that allow rolling funds now to publicly solicit investors, as long as they're verifying that all of their investors are accredited investors. So when you see somebody on Twitter who has 100,000 followers saying, hey, I'm launching a new fund, let me know if you want to get involved, they're not violating the SEC rules anymore because of the new exemptions that are out there. So you'll see operators now, this is becoming more common, that entrepreneurs who are currently operating their business are now running a venture fund on the side. That was never the case before. And only a couple of years ago did this happen, where you can be, the founder of Gumroad, for example, he's building Gumroad and now he's managing a rolling fund. And I won't get into the details of rolling funds. One way to think about them is it's a new LP that's entity that's created once every quarter, and you subscribe to participate in a series of these funds. So that's why they're called rolling funds. That every quarter a new fund essentially is launched, but you have investors who are signing up to subscribe to these funds. So that's like totally new. That has never happened. And now you have entrepreneurs who are choosing to raise from influencers as opposed to traditional venture funds, because the influencers can give them distribution, or they can give them audience. They can bring different things to the table that VCs historically haven't been able to do or haven't really invested much into. So that's a new development. We're seeing the rise of angel syndicates. So if any of you follow Jason Calacanis, you can see that he's out there saying, hey, he has 10,000, investors that want to participate in his deal flow. So if you have deal flow and you have an audience, you can now become a venture capitalist that manages the community's money, essentially, by bringing them into syndicates, into individual investment opportunities. That's relatively new. And the next stage that I see going on right now, so if you think about like what the industry was, when we started, we were the only seed fund in the region that wanted to take the early risk on the entrepreneurs. And now you see more angels, we have angel syndicates that are doing more of the seed investing. You have influencers now who are raising rolling funds who are competing directly with us to do the seed capital in these companies. And now there's this new thing happening that I'm really excited about, which is the launch of decentralized organizations. So now I'm starting to see that there are groups that are pooling money. So think of a community that is pooling money. It's a community with a common bank account, and you get a vote on where you want to allocate your capital. DAOs, so decentralized autonomous organizations, are being used to purchase films. There's an attempt to buy a copy of the US Constitution through a DAO. There's investors who are pooling their crypto in order to buy NFTs that they collectively believe in. This is all happening so fast, and I'm starting to see more companies now that are raising money through DAOs. So this is a brand new category. It's in the gray area in terms of regulations, but I think that trend is really, really powerful. So, and I welcome any of your questions about DAOs and decentralized orgs as I move through this. But I wanted to, draw a clear distinction in everybody's minds between who can participate in venture capital in the United States. There's this concept of an accredited versus an unaccredited investor, and there are reasons for these rules. They don't want grandmas to put their life savings and their retirement into their nephew's startup and lose it all, not understanding the risks that they are taking. It's a paternalistic approach to protecting the citizens, but there's some reason for it, to avoid scams and total wipeouts of individual savings. So the government implemented this rule that said, you have to make a certain amount of money per year or have a certain net worth in order to even participate in venture funds or to invest in startups. So, this obviously excludes the vast majority of Americans to participate in, some of the assets that produce the highest return that's available to them. And so I personally see this very frustrating that people who want to get ahead can't even participate in the growth assets very easily until they've already gotten ahead. I think it's gonna go away. So my belief is that we're going to see more there are going to be rules passed that allow unaccredited investors to start participating in DAOs, rolling funds, and venture funds going forward. And that's already happening. So you can anticipate even more capital now becoming available at the seed stage, as unaccredited investors are now allowed to participate in this industry.
Dalton.
And what does that mean? So when you have more capital entering into a space, there's more competition. So competition is good for entrepreneurs. It means that you get better valuations, better terms. You get to select who you want to work with. You don't have to just choose the one firm in town to work with. You have differentiation of offering.
Hey, Dalton, can you hear us?
Yes, I can.
RC is trying to get in touch.
I had a question. I just had a question.
Sure.
You're like really chugging along, so I didn't want to derail you, but I just had a question based off of what you were talking about, accredited versus unaccredited. Where do friends and a lot of the time startups, especially ones that are pre-seed, they have like friends and family capital that they're working with. Is that kosher, or is that, so can you talk a little bit about what you know about that?
Yeah, generally, like if it's a very small amount, as VCs will look at that and say, okay, that's probably not a huge risk, but there is risk. If we look at a company that has already taken money from unaccredited investors, it means that those unaccredited investors could down the road sue us saying, hey, I wasn't able to make that investment decision. And if the company didn't work out, I'm going to sue the shareholders. I'm going to sue the company to return my capital. And so it puts us in a weak position as investors to invest into a company that has already taken friends and family round capital if they are not accredited. And so there are certain cures, for that, as the legal due diligence process will ask unaccredited investors in order to sign an acknowledgement. There are different things that you can do to solve that problem, but I think that is part of the problem, right? That that you're telling people that they can't raise from their friends and family, because of these restrictions. Some of these restrictions have been addressed with the Jobs Act, and so now unaccredited investors can invest in these companies, but they can only do a certain percentage of their assets and only a certain amount per year. That's kind of where the Jobs Act came in and said, yes, that's why crowdfunding can exist with unaccredited investors. And so as long as you would look at those individuals and say, are they complying with the Jobs Act, even though they're unaccredited? For me as an investor, the safest thing for me to say is every single shareholder in this company, investor shareholder, is an accredited investor. But because of the Jobs Act, it creates some protection for unaccredited to participate in these companies. So I would say, these are questions that definitely talk to your counsel about, before taking money. Always talk to counsel before taking money from anybody, and make sure that you have your investment structured in a way that's not going to create problems and liability for you down the road. And the more you raise from unaccredited investors, the more liability that you create for yourself.
So it sounds like the biggest downside to it is just how future investors will view your cap table and whether or not it's a good idea for them to invest in your company.
Yeah, it might deter some people to invest. And there is the liability of people. Like in our fund, if we raised from unaccredited investors or we did a public offering or anything like that, it means that halfway through, all of a sudden you could get sued and they could back their money back out and just totally disrupt our flow as an investment fund, in order to accommodate people that are saying that they shouldn't have been able to invest in the first place.
One comment on that is that, what I've seen personally, so every investor, when they invest in a private deal, you essentially have to sign an accreditation form. The thing is, they used to be very, very much kind of don't ask, don't tell. In other words, you have to sign here and tell us that you qualify under one of these 4 categorizations. And most recently, the one that I invested in, they did a deep dive on, what are your assets in this category, in that category, et cetera, et cetera. So I think it's something that is there's a lot more scrutiny right now than there ever was before.
Yeah. Yeah, and there are companies that are trying to figure out how to take in unaccredited investors into a hedge fund structure so that you can invest into what feels like a more defined vehicle that allows you to invest in it, and then they turn around and invest it back into venture assets. And so I think that this is a hot button topic in the country right now, because I think blocking people that can't invest in this category is essentially stagnating their ability to drive returns through their investment strategy. Because where's the yield out if you're not investing in growth? Or that's not always the case, but for much of the past decade, you weren't invested in growth assets, it's hard to actually make your investment strategy work. And so I think that's going to be a really important topic. And I think more Americans are going to be able to invest. And the Jobs Act did a good job of taking a first step there. And I think they're going to continue to expand that with some protections in it. I do know that there are a bunch of chats, and I see some hands raised or questions in the chat. I would just maybe conclude by saying, what is at the end of the day, an entrepreneur, what are they looking for from the investor? And so as there are more options available to entrepreneurs, what's the consistent thing that they want from that capital? What are they seeking? And I would say that what they're seeking is improved odds of success. Most entrepreneurs, most venture-backed startups fail or have kind of unremarkable outcomes. And so entrepreneurs know this. And so what they want is a better shot at hitting the home run by raising from the right investors. And so, okay, how can an investor increase an entrepreneur's odds of success? First of all, providing capital so you don't run out of money, helping you raise from follow-on investors. So keep the business capitalized first and foremost, but attracting talent to your business, helping, the best companies are magnets for talent. Think of startups as like an aggregator of the very best talent that condenses into and forms something that then produces an output far greater than the sum of the parts. So getting the best talent in the earliest days, subsequent employees don't want to join a startup that has B talent. So A players don't want to join a startup that's full of B players. So in the early days as an entrepreneur, one of the tests of your quality as an entrepreneur is your ability to motivate people who have way better job opportunities to come join your startup. Like every talented person can make more money taking a traditional job as opposed to joining a startup in the early days, but they have to believe in this big opportunity. Why would they join? And so, one of the tests of a great entrepreneur is, can they compel people who are much better than them to come take a chance and join their vision on this company? And VCs and other investors can help bring talent and credibility to a company that increases their chance of success. I'd say also partners, customers, distribution. If you're a fund that can help companies go to market, you've got an advantage. If someone's choosing between your dollars versus somebody else's dollars, distribution could be what makes the difference. And then strategic and tactical advice. So you think about, these are value add items beyond the capital that you're providing. So then you start to think, well, how do the different structures, what are the strengths and weaknesses of angels and venture funds and angel syndicates and rolling funds and DAOs? Where do they stack up on these different categories? They can all provide capital, but where are they able to provide access to talent, better distribution opportunities for your company, better strategic advice? And there's one of the reasons why the Web3 concept is so interesting is the user-owned companies, is that it's a way to jumpstart a community that can provide distribution. It's also one of the reasons why influencers are having a lot of success with their rolling funds, getting in deals, because they're able to drive adoption of the product out to their network. So if you happen to be a deep domain expert in AI and you have a following of AI, an audience that loves the topic of AI, chances are you're going to be able to push things back out to your audience that's of value to the companies that are taking money from you. And so that's one of the reasons why I think this idea of community investment in companies is really powerful, because as VCs, it's a partner writing a big check. There's value in being able to write a check. The entrepreneur doesn't want to talk to 1,000 people. They don't in order to raise the money. Talking to one person's a lot easier. Getting one check's a lot easier than a bunch of checks. But I'm just one person, or the next VC is just one person. Is it possible that 1,000 individual investors will create way more value for the startup than I can. Absolutely. And I'm seeing that more and more, that the long tail of investors who previously weren't playing in this game might be able to generate more value for the companies they're investing in than the VCs that are writing the bigger checks. And so the value add doesn't necessarily correspond with the size of the check that they're writing. And that's where you're starting to see entrepreneurs saying, you know what, I don't want to announce that I raised from some other VC. I want to announce the 5, name brand angels out there that have, collectively 5 million in followers in their network. That's more interesting for some founders, depending on their business, than taking capital from just another VC. So I'll pause there. There's a lot of different avenues we could go down from here, but I know you have questions in the chat. So let's go ahead and open up to questions. And I'll start by just taking a look at some of the questions that you've already asked. Let's see. I don't know if I'm able to read on the fly and answer the questions here, but let's see. I'll start from the top.
Help a little if you want, Dalton. So Chase has his hand raised, and he also put a question.
Chase, please.
Chase, go for it.
Yeah, I had 2 questions for you. My first question was, well, first of all, thank you for speaking to us. But my first question was, are you seeing non-Web3 startups being funded by DAOs, or just pretty much like crypto projects leveraging those communities?
Yeah, mostly crypto projects so far. I'm expecting that to change pretty soon. There are DAOs that are launching that are able to hold safe notes. And so there are ways to bridge this world where, you can invest, you can hold the traditional investment instruments on your DAO. You can tokenize your safes. I'm working on a project to tokenize carry back into DAOs right now. I'm also working with a company that is tokenizing RSUs, so that if you're a company, you can, take a percentage of your option pool. Right now, it's like, okay, what are you going to get for your 10% that we help you create? When we invest in a company, one of the major conditions that we'll put into our investing is, okay, we need to see an option pool to go recruit the world-class talent that you need. But what if 1% of that option pool should be given to a community that is supporting your development? What if you put that equity into a DAO that the community could then come earn rewards from that equity based off of their contribution to distribution, marketing, feedback on products, R&D, any number of things that the DAO can set a principle of what they're trying to optimize for, provide equity linked incentives to that DAO, and then the participants in that DAO can drive value for your traditional company. But most DAO investment syndicates so far have been focused on other Web3 companies because of the crypto to crypto transactions, and also the jurisdiction, the on-chain jurisdiction of these companies. Where the United States needs to get on the ball is providing more regulatory clarity for these types of organizations to invest in traditional companies. Because if I'm an entrepreneur and I'm trying to decide between raising money from this, potentially unaccredited group of crypto investors in a DAO versus an angel syndicate with accredited investors or a VC, I may look at that DAO and say, well, that's a pretty cool community that could drive a lot of value for me, but it's not worth the regulatory risk for me to take that money, because it poses an existential question for my company. So once the United States actually provides more guidance around how they're going to treat tokens as securities or not as securities, we're going to see an explosion of innovation in the space. But right now, it's not yet quite there, but it needs to happen. It needs to happen, in my view. If the United States wants to stay at the forefront of innovation, we're going to lose ground if we turn our backs on Web3 innovation right now. So I could go out on a longer, tirade about why the United States needs to get this right and where my concerns are. But the short answer is that, yes, I'm not seeing DAOs funding very many traditional companies yet because of the the risks around accreditation.
Thank you. My second question was, you touched on friends and family money kind of like tainting the cap table and creating additional risk for accredited investors to come in later. I'm wondering if utilizing like a roll-up vehicle somehow reduces the risk for traditional VCs to move in later on in the process, like to do a roll-up pre-seed and then going into the seed stage with that single cap table entry. Does that help the process in any way?
It definitely helps from like an optics perspective. I mean, once you have a certain number of shareholders on your cap table anyway, you start to get into requirements to be a quasi-public company. And so you want to, that's not an issue for most startups. It's not like you're raising from 1,000 people, but if you're doing crowdfunding, they tend to roll all of those participants into a single line item. So it keeps your cap table cleaner, keeps the caps on shareholders, manageable or below that threshold. As far as the liability, that's partially what AngelList manages for rolling funds or syndicates, is that they're the ones who are doing the verification and receiving the statements of ability to invest. The individual investors attesting to their accreditation status, or if they're investing under a crowd-funded vehicle, they're basically attesting that they haven't exceeded any of their investment limits established by the Jobs Act. So yes, there's a good reason to roll individuals up into a single entity, but to technically be clear, you need to make sure that the individuals behind that entity have also, been cleared by this. And so I wouldn't, I wouldn't stress about this too much. I would just talk to counsel and just say, hey, we want to raise money from my uncle. What's it going to take? And he's going to say, well, he needs to be accredited, or he needs to attest to the fact that he's able to make this investment under the Jobs Act.
Thank you.
Mm-hmm.
Okay, next up is Curling Robinson. You have a question?
Yes. Thank you guys. This is a great event, Arcelia. I'm a USC alumni. Helped a lot with Blackstone, Marshall, and Ivy and Young. Eddie, I think you even mentioned Dalton Gumroad. I think I think he's USC alumni too. I think so. I think
cool.
He might have dropped out, but he's totally USC. My question was I work with a lot of VC groups like Backstage Capital. I'm like a small fund too. But one question that they just did use Republic.co to do some kind of equity campaign to raise for their operation. What do you think about that? Is that some new trend with certain VC funds? That's my part one question, but I'll let you.
Yeah, so I actually am not familiar with it. So maybe just tell me a little bit more about what they've done.
Yeah, so Republic.co is kind of like a big equity crowdfunding platform, right? Usually mostly groups. I work with about 300 startups that kind of use that kind of process, but I've never seen a VC group do it. So they raised about $5 million last year during the whole COVID kind of part for their operating kind of fund. I believe it's about 700 subscribers, but it was just a new type of thing, me seeing a VC doing that versus going the LP route and things of that nature. So without having, and I do know Republic, but as far as like a VC using that in order to create like a different type of an LP base. Yeah.
One thing that I see a lot of funds doing is trying to involve the members of their ecosystem or their portfolio into their fund. And, it's like, for all the reasons, we don't want to have more than, it changes how we have to report if we have more than a certain number of individuals as LPs in our fund. And so we have to stay below a certain threshold. So this allows you to set up kind of a separate vehicle that, CEOs and members of management teams and advisors in the community can participate in as actual and to get engaged in offering advice back to the portfolio companies that you're looking at. So I see, and I don't know if that's specifically what they're doing here, but I definitely think the strategy is going to, that strategy makes a lot of sense. And we've, as VCs, have pursued this in different ways, trying to involve our network in sourcing, vetting, and adding value to the portfolio companies that we're involved with. And historically, you might have, given them some advisor shares or maybe even given them a little bit of carry. But these new structures allow them to actually have a more concrete stake in the companies that you're investing in. And so I see that continuing to happen. I'm a big believer in the wisdom and the capabilities of not the crowd, but the individuals within crowds coming together in important ways. And the old model of, 4 VCs sitting around the table, deciding investments and then also thinking that they can add a ton of value to these companies when they're making hundreds of investments. I think that's giving way to more accessibility of investors to directly add value to companies, whether it's as investors or as equity earners in the companies that they're providing services to. And so for me, that's part of my excitement about where we're going, is that I think you can work directly for equity as opposed to having to go join the startups. You can work for multiple startups at the same time as an advisor or as a software engineer. That's starting to happen more frequently, which is, it's kind of scary in some ways for CEOs trying to manage,
Sure.
their employee base. If you've got some of your development's been done by participants in a crowd that have avatars, you don't even know who they are. But that's kind of what's going on right now. That's what's happening. So yeah, but I will look more into that. I appreciate you bringing that up.
Yeah, no problem. And just my second part, I know you were talking about blockchain and things like that. I'm in San Diego. I'm part of this group called Startup San Diego. So we do a lot of blockchain stuff with some of our startups. one question I have for you is that this kind of old term, but there was some of our startups, like Nano was one. It's kind of a VR company that works with molecular structures and stuff. But they actually did an ICO, like maybe about 3 or 4 years ago. I think they raised about $6.5 million. Do you see that? I knew they had some issues after that was done, but do you see what that's going to morph to? Maybe it just be a DAO or things of that nature. I'll leave it up to you.
Some companies are going that route. I mean, the big problem with the ICOs was, the attorneys, kind of, grudgingly signed off on it, to actually let their clients go out and do these raises, even though they knew that most of them would constitute a securities offering or some sort of a public offering. Sure. And so, and now, everybody's kind of in a limbo position waiting for additional, legislation and clarification of legislation that's already been passed. And so, yeah, that's one of the reasons why traditional investors, the fund that we're investing out of now, it's the first fund that we've ever actually explicitly been able to hold digital assets, right?
Got it.
Finally, we can invest directly into tokens. In the past, it was, there's a lot of gray area there. And so, and there were a lot of violations of securities laws on that fundraising strategy. And so I'll give you a sense for some of the investments that we're making right now. I'm investing in equity rounds. So I have two companies right now that it was very similar deals, $3 million rounds, where we led the $3 million equity round, traditional seed stage equity. But as one of the terms that was included in it was we're receiving a warrant to a future token offering. And so that we will have a warrant for a de minimis amount of money, be able to buy our pro rata share of the treasury, the fully diluted share of the treasury, once they issue their token and they launch their actual token. And I get involved, and I'm going to help them do that in a way that's compliant. So I see that as a lot of companies are raising still traditional equity, but then after the seed Series A, they eventually bifurcate where they're no longer raising from the traditional VCs, and now they're funding their business through the token offering.
All right, thanks, Dalton. Arcea. Thanks.
Sure. Great questions. Okay, moving it on to Jacqueline Jones, and then after Jacqueline, Julian. Go for it, Jacqueline. Oh, you're muted, Jacqueline.
Got it. Hello, Dalton. Thank you for being here to speak to us today. My question is around the diversity of, I guess, selection of companies. Right now, I'm sure you're aware there's really very much a lack of diversity in who gets funded and who doesn't. And so I thought I would ask the question, what do you think VCs should be doing differently so that they can broaden their reach?
Mm-hmm. Yeah, I think, at the end of the day, investors, our mandate, unless there are a lot of different types of investors, but our mandate is to drive the best returns. And so we have to find the very best opportunities, and that's what we have to focus on. And so I think for us, we've discovered that some of our best returns were in overlooked founders, right? And so it's not, you justify some of these initiatives not based off of the social impact, because that's not what our mandate is. There are social impact driven funds. Our mandate is to drive the best returns, but we've also discovered that some of the, as I mentioned, that if you're fishing in the same pond as every other VC, you're going to end up with lower returns because you're going to have more competition for the same companies. And so one of the things that we did when we first hired for Kickstart, when I came back to Kickstart, it was all white guys on the team, and it's still at the partner level. That's who we are. I don't want to, I'll just tease it. That's changing with the new partner that we're bringing on. And so we're making inroads there, but the investment team that we have is now not at the partner level, but at the associates and principal we have more women on our team than men. And the way that we got there was by investing early on in developing talent. So I set up a fund called Campus Founders Fund. Topic for a different date, but Campus Founders Fund is a student-run venture fund that I'm going to convert into a DAO, and I'm going to give the ownership back to the students. But they've already identified a company that's going to be $1 billion company. Their investment strategy is totally working, investing in other student-led startups. And from the very beginning, we said we want to have a diverse group of students managing the student-run venture fund, because when we would put out a call for applications for a principal or an associate position in our fund, the reality is we were getting 99% of the applicants came from either BYU or the University of Utah, and they were all white guys who had worked in consulting or investment banking, previously. And we didn't have the, I guess, the flow of talent to really make those hires. So with Campus Founders Fund, we explicitly said we're going to have a diverse mandate and bring more people into this Campus Founders Fund. And that's where we started being able to hire for diversity within our portfolio. As far as our fund is concerned, there's like this Twitter account out there called VCs congratulating themselves. It's like all the VC Twitter out there, like kind of humble bragging about how good they are and everything. We've, as a fund, we track the data on the diversity of our CEOs and our founding teams, and we're way above the national average. We're way better than the Bay Area in terms of backing minority CEOs, backing women, backing teams that don't look just like us. But it's also one of those things where I can't be the VC that's like patting myself on the back, like, oh, look at all the good that I'm doing. That's not, I would be a fool to try to promote myself that way, but it is something at Kickstart that we care about. For me, so that's a question about our firm, but the industry at large, yes, we need to have more representation. We need more women, more people of color on boards and with check writing capacity. That has to happen. And so we're in the process of trying to bring more diversity on our boards. It's not the easiest in Utah, but we're making progress there. But what I think, one of the reasons why I'm so optimistic about Web3, one of the reasons is that I think it allows for pseudonymous engagements in networks. So you can actually, and this might be, altruistic hope that's coming out of me right now. But in these new arrangements, you can participate in investment decisions. You can participate in networks without actually having to disclose your identity. And so you have, in a world where people can opt into participation and you're judged based off of your contribution and nothing else, because there's nothing else to go on. Your avatar, the way that I know you as my coworker in a DAO is that you're the yellow dinosaur, with the funny hat on or whatever, like that might be what I know about you. And so my biases that I have are kind of irrelevant to a certain extent. And so I'm optimistic for the ability for more people to get access to venture and to technology through pseudonymous networks, because we can try to change bias, we can try to change hiring, we can try to change the pipeline, and I care about this. But I also think that the way companies recruit and attract talent in the future may allow people to engage without having to disclose. They can choose selectively what elements of their identity that they want to disclose. So for me, that's one possibility, but I think a lot of it comes back to education, role models. My wife is Mexican. I met her when I was down in Mexico. She started a company focused on immigration. It's a company called Simple Citizen. And she now is a mentor to a lot of other Latina women who are interested in seeing role models that have done this before, right? So that's the other thing that I think that we just have to continue to invest in and support is showing people, role models that they can relate to, and that they have paths out. So it's paths in, I should say, into the venture business. And that's been hard to do in the past, but I wish I had a better answer for you. It's like, here's the answer. It's just, we have to do more. And I feel comfortable at Kickstart that's been something that I cared about when I came back. And I said, we need to invest in a more diverse set of CEOs. The good news that's the results of that so far have been, there was no trade-off for us in terms of the performance of our fund.
That's really great. That pseudonymous, the avatar thing. That's really interesting.
I don't know where it'll go. It's unclear, but you have this concept. One of the companies we invested in is in decentralized identity, and you think about if a credential. This is a category called verifiable credentials, and if I go to a bar and I present my driver's license to the bouncer at the bar, the bouncer wants to know, is this guy 21 or older? He doesn't need to look at my ID and say, oh, interesting, you're not an organ donor. Or, oh, I didn't know that you live on that street, or that's how much you weigh. Or, all these things, it's like information that's not necessary for the bouncer to know whether or not. The bouncer doesn't even need to know that I'm 20, what day I was born on. They don't need to know how old I am. They need to know that I'm older than that I was born before a certain date. And the network can provide a verification. So a decentralized network can provide the credential back to the bouncer, given just a green light. Can this person come into my establishment or not? Green light. I don't need to know anything else about this person. Same thing happens with lending right now. You know, the amount of information you have to provide to get your mortgage, it's a honeypot for hackers. That's why we have all this, you know, identity protection solutions out there, because our identities keep getting hacked, because we keep providing more and more and more information to transact on the web. And it's not necessary. The network itself, once you have a decentralized network, can prove this person is a lendable candidate here, based off of the rules that you, the lender, provided. If you say, I need to see this credit score, I need to see, you know that they have this number of years of consistent work history, whatever your underwriting criteria is, you can state it in a way that the network can then say, okay, we've got a match here. You can lend to this person without me needing to look at their family history, you know, look at like even their name, you know, potentially. Like there's so many areas where bias can get introduced. So I see verifiable credentials and decentralized identity as a way for people to transact with the minimum viable data transfer necessary. What's the minimum information you need to know in order to underwrite me? And I can give that to you in a way that you don't even have to see the underlying information. You don't need to know what my credit score is. You just need to know that it's above 750, because that's the threshold that you set to underwrite me. Those types of things. It applies to a lot of different areas, not just lending, not just mortgages. Anywhere you're providing information about yourself or a counterparty now to transact with you, now can be done in a way that can be more blind to a lot of the data that sits behind these networks. So that's an area of hope for me in this area of accessibility, inclusion, that, you know, we can try to overcome people's biases all day long, but we can also just make it impossible for people to discriminate and yet still accomplish the business objectives.
Thank you so much for that.
Sure.
Okay, gonna move this along to Julian, and I just want to give a little time stamp. We're at 1:24 now. I don't know if you can stay on later than 1:30.
Yeah, I can run over. Yes.
Okay, so go for it, Julian.
Hey, Dalton, that's fantastic. So we're in the Viterbi Start Garage. We've raised from angels, venture capital, corporates, like across the board. The question I was going to ask was this DAO concept, and like understanding a bit more about it. I can see the conceptually where you're going is like really interesting around the amount of information about people to be part of that collective group. The question was really more around how the decisions are made as a group. So sometimes, you know, when we've raised from angels and stuff, angel groups, you sometimes can end up in either confirmation bias or social confirmation bias. And so you actually have to back channel through champions in order to get decisions made. And part of the reason we go with some angel groups is actually because implicitly they have networks. So, you know, you were making that argument about, you know, people in the DAOs able to help you with distribution and network partners. So I was just trying to figure out whether you think that group decision-making or that implicit bias that we normally see in kind of angel groups associated with that, or angel syndicates, whether you think that that's going to be reduced or increased if we, around the decisions that are made for investments. For the investment that is made, or whether that will lead to more contrarian investments when a group comes together in that way. So that's really.
Yeah. I think it's a great question, and you know, decision design is something that gets talked a lot about in venture funds, because what's the better investment at the seed stage? The one that only one partner in the firm believes in, or the one that they all believe in? And you might, if you ask that question to different VCs, they might answer it differently. But what I believe is that the best outcomes are the ones that are high conviction by an individual, that, you know, that are controversial. Generally, like the companies that because to really make it big in VC, you have to be willing to take a contrarian position at some point. You can't just invest in the safe thing that everybody's like, oh yeah, that's a great investment, I want in on that too. The more that there's like collective groupthink as you put around it, I think the more you're going to have like middling outcomes, because it's really hard to believe, like for most people who are, if we were an investment network, just everybody on the call right here, and before Airbnb existed or before Uber existed, somebody got on pitch this Airbnb, I'm pretty sure that most of us would vote against Airbnb, because most VCs investigate. Now, maybe the crowd, the consumer crowd would have a higher hit rate. I don't know. I'm interested to explore that. But I believe that like the real like outlier investments oftentimes seem so stupid in the early days that like it's logical, it's rational for people to believe that this is going to fail. And so when, it's all the arguments against why people would not open their homes up to let strangers sleep in their beds are completely legitimate. They just happen to be wrong. And so, that's something that I'm trying to protect against in our firm, where we don't want consensus groupthink basically on the decisions. We want to make it possible for an individual partner at Kickstart to be able to make an investment decision and not have to like convince everybody in the firm that this is a good investment. And what we've seen is that most of the great outcomes. So how does this tie into like collective group decision making in DAOs and organizations where you're trying to get a group to make a collective decision on an investment? I think this comes down to a lot of people. I think when they first hear about decentralized autonomous organizations, it sounds like amorphous, no structure. It's like the mob rule, majority vote. But there's a lot of different structure that will be built into this. You'll have credibility weighted wallets. So this is similar to Ray Dalio's principles of ultimate transparency. So I imagine that in the future that there will be DAOs where you can look at individual wallets and maybe not know who the person is behind them because of the pseudonymous nature of some of these organizations, but you can see like, okay, which wallet has the most credibility? And so can we assign additional weighting to their vote on investment decisions so that it's not just one-to-one? Can I drop an NFT that's like a 2x multiplier because this person, has now confirmed that they work for a top 100 venture fund. And so I believe that they're more credible as an investor because of their experience. There are a lot of different things that DAOs might do in order to attract the best decision makers to their DAO, and then incentivize and provide recognition for the people who have a track record of picking winners. And you'll in those organizations you'll have more of kind of like a republic in some ways, where individual investors could vote directly, or they might proxy vote or allow this a more credible wallet to proxy vote their stake into these investment decisions. There are a lot of different ways that this might be done. Another category of investments is like quadratic voting. And so like, are there ways to actually tease out how passionate people are about their investment decision? So quadratic voting is oftentimes cited as ways to eliminate the extreme selection of candidates and parties, right? Where how is it that we end up with every time around lately in the United States, presidential election, how is it that we end up with candidates that want, each side hates the other candidate, deeply hates the other candidate? Why is it that we're creating a scenario where our two options are half the country is going to be pissed because of who got the majority, and we all hate the other person? Like that's not healthy. And so are there ways within using quadratic voting to tease out like where people's real passion lies? And who they're supporting, and I think that that's going to be another popular way of trying to measure intensity of conviction to an investment decision that they're making, even though they might just be making a single vote. So that's a category that I'm interested in. This is like really, really relevant for what I'm trying to solve for with I mentioned the Campus Founders Fund. I'm trying to convert that into a campus DAO, and yet I don't want it to be just a majority vote. I want to be able to get the right signal. That's what I want. I want the group to generate the right signal on the investments that we ought to be putting money into. And that's cutting edge, right? It's like, there's not really a lot of, to my knowledge, literature that's been published about way to design group decision-making on an investment decision that still respects, that acknowledges that outliers are almost never consensus decisions. Like the riskier, higher outcome, but riskier, but higher upside opportunities rarely have 50% of the people looking at it saying, yeah, we ought to do that. It's almost always they're very controversial. And so how do you set up a network, a DAO that can accommodate extreme opinions, and it's still at the same time allow the participants in the DAO to get comfortable with the opinions that are being voted on? So anyway, it's complicated and there's no clear answer yet, but you're asking the right question there.
But I don't know, just one thing to reply to that. I think another good qualifier would be baggage of industry, because sometimes if you can't see the forest from the trees, you'll think that cannot be done in the thing that I do. Yeah. And so it'd be interesting to do a weighting of that as well on a decision, but it would lead to a more contrarian decision than a, incumbent decision. Yeah.
And what I'm excited about, I love that too, because, the conventional wisdom might be like, let's weight the members of the DAOs, the vote, who has a domain expertise or is a domain expert in this category. But you're right that so often it's the outsider to an industry that can come in and be the one that actually sees how it can change. The person who's already been it says, oh, I already know why that won't work. And they just happen to be wrong. And so I love the experiments that we're going to run to see like, okay, because we're going to have so much better data, and all of these votes are going to be done in a way that's, on chain, immutable, so that you can actually do retrospective learning. And I actually think that how these DAOs evolve and get stronger is that you can look back and see how decisions were made, and where, reward good decisions, and, de-emphasize participants in bad decisions. And over time, we'll probably get more of a science, about how these like collectives can make, outlier predictions when you don't need, 50% more. But yeah, I love the thoughts about like, that's a contrarian thought that you're just sharing, is that like, oh, maybe you ought to weight the wallets that don't come from the industry, right? And like DAOs are going to experiment with that.
Yeah, awesome. Thank you.
Great job. Okay, so we have Anand with a question, and I know that Dave Eastman also has a question. I also have a question. We are like at time, and I know you can stay over. Really quickly, I'd like to just shamelessly plug our next event, which you guys can see behind me. We very rarely have open legal clinics. Usually our legal clinics are just for the teams at the garage. So every once in a while, we manage to rope in a lawyer to come and help out you guys for free, which is not cheap. This is going to be employment law. So if you guys are looking to hire, or if you guys are doing stuff with interns, international employment, things like that, where you want to make sure that you're not making huge mistakes early on in your business that are going to be costly. This guy's going to be the one to answer those questions. So please join us. That's next week on Wednesday. The link is in the chat. I'm going to pass it to Anand now. Go for it, Anand.
Thank you. So I'm going to be the party pooper here and going to not talk about the DAO and the Web3, coming back to the current world that I'm in, which is the more raising of the money. One of the things that I have been doing with, I've hired an intern to do is, when I'm going to know that I'm going to go out and reach to a particular investor, we look at what they've invested before. The reason we do that is more so, and I want to kind of get your thoughts on, hey, is it justified or not? I want to know if they have a technology or they've invested in a technology that could be either similar or tangential, that they could just turn around and give that idea afterwards to that company and say, hey, by the way, perhaps this is a better idea. Am I being paranoid?
I think that there's room for some healthy paranoia. I think that you don't want to pitch your company to a VC that has an obvious competitor in the portfolio. I think most VCs, I hope most VCs practice professional ethics, that we don't, send pitch decks on to other portfolio companies and say, hey, look at this company I saw. And that's how we are. We're not going to forward decks along or anything like that. But I do think that just the reality is that if I'm on a board of a company in a space and I saw another company that's doing something really cool, I'm going to be trying to do everything I can to help the company that I'm on the board of to be successful. And whether or not I realize that I actually picked up that thought from some other pitch that I heard, it wouldn't be explicit like, oh, look at what they're doing, let me send this to you. But it could be in the next board meeting. I'm like, hey, have you ever thought about this or that, right? And so I think there's probably some room for, I think it's wise to filter out the VCs that you're talking to and exclude groups that have already invested in companies that are going to be directly competitive to you. But the reality is that, especially at the seed stage, a lot of companies pivot so much that we don't know actually the directions that they're going to go. We have companies that they weren't competitive when we first invested, and then they end up competing with each other. And so it's hard to really have a hard and fast rule that, oh, we'll never invest in competitors, and you shouldn't worry at all that one of our companies might actually be in your space one day, because we can't control what our portfolio companies do. We have some influences if we're on the board, but the CEO and the team, they're able to pursue the strategies that they want to pursue. And so I generally, though, I think that the best entrepreneurs move faster than anybody, and they're not as concerned about someone stealing their idea because they know how hard it is to actually execute. And most entrepreneurs I know that are very successful are among the most open about what they're working on, where they're going. And I have almost never seen it backfire. I have almost never seen somebody think, oh, why did I shouldn't have tipped off my competition. More often than not, the experience of the entrepreneurs that I observe is that the more open they are about the things that they're excited about, just attracts more talent, more capital, more partners. And so if you're trying to protect it so much that you don't want to talk to other people about it because you're afraid you're getting out, you've gone too far. You want to talk about your ideas. You want to be open. You want to be out there, and you want to rally people to your business. And you can't do that by keeping it, hit up. But as far as like sharing kind of true secret sauce with the VC, what I would probably do is, if you're uncertain with the VC, you're like, yeah, they have relevant experience. That's what we want. So they've kind of invested in a space. I'm not sure if these companies in their portfolio are competitive or not. What you can do is have a version of the deck that's fairly high level. It might be stuff that you can just find on your website. It could be just general market, information, and here's the problem we're solving. Here's how we're solving it. But getting into the details of like, here's the secret sauce, here's our actual revenue. There might be things that you want to leave for the next meeting. So have something that you can send to a VC and let them know whether or not it's competitive based off of a quick look, without giving them any, kind of crown jewels to your strategy that they could then inadvertently or intentionally reveal to another portfolio company. So I think having kind of a light deck that can be followed with a more substantive deck is a decent way to handle that challenge.
Great. Dave, you're there. You have a question?
Yeah, Dalton, thank you. This has been fascinating. You've really touched on primarily, call it organic or secular evolution in let's say, the early stage financing market. Could you take a step back and address what your thoughts are on, I guess, where we are cyclically? I mean, you've lived through 2008, I lived through 2000 as well. And, suddenly the availability of capital and the standards, and look, we saw it and we discussed it, early in 2020 during COVID. What do you think happens, I guess, to the venture market in the next capital crunch, which who knows when that's going to be? And also, how do you think that impacts the new financing venues that you've been talking about, their growth, their evolution, the availability of individual capital, et cetera?
Yeah, really good question. Well, first of all, I think that we're already seeing like public, tech multiples crunch down, right? And so you usually see that start to wind its way back into the private company valuations in a quarter or two. And so I'm already feeling like there's, some pullback on valuations, but I don't think we're not going back, at least in our ecosystem, we're not going back to the days where we're doing seed rounds at a 5 million pre-money valuation, maybe occasionally, but I just don't see that happening, because you're still basically betting on the outlier potential, the upside of the companies, and you don't know which ones are going to be the outliers. And so I think that for competitive companies, they're going to be able to raise on attractive terms going forward. I think that you're going to see where I would probably not want to be playing right now, maybe in another year or two, but the Series B growth rounds, that became so competitive with the mega funds coming, down market and doing like big checks, earlier than they would ever do, just believing that they're going to give them enough money to grow into the valuation. And so I saw really irrational valuations happening at the later stages. Marketplace companies getting valued at like 40, 50 times GMV, when their take rate's 20%. I mean, just things that can't hold up, that it cannot hold up. You have to, in order for that valuation to work, you have to just hit a home run with it. And as we know with the portfolio, you're not going to hit home runs on all of these companies. And so, yeah, I see valuations moderating at the later stages. I see it moderating a little bit at the seed stage, but not dramatically, because the expected upside for successful seed stage companies is still, multi-billion-dollar companies. And if you're investing in the teens valuation, I don't think you're going to see a lot of like push to drive that below at like a 10 pre for seed stage very often. Maybe I might be totally wrong, but I'm not really expecting that. There's more capital available. It's you're still competing for the very best deals, and it's an outlier driven game. And so, yeah, go ahead, Dave. I don't think I'm answering your question.
No, you're answering it very well. I guess the corollary to that is a lot of the new financing vehicles that, as you say, are kind of they're driven by evolution of regulation, et cetera. Whether it's DAOs, whether it is just different crowdfunding vehicles. That, I guess, is a little bit like angel funding in the sense that it's all driven by individuals, high net worth individuals who, look, a fund, especially as we've seen a couple of times recently, if you have closed your fund, you actually, the market collapsing is the best thing that could happen to you, because you've got your money and you've got more attractive valuations as you go into the next cycle. For individuals, let's say, who are in public stocks, who are in real estate, whatever, that may change their willingness to participate. So you might see angels impacted, and therefore, DAOs and other crowdfunding vehicles. Can you kind of address that?
Yeah, I mean, it's just like as we raise from large institutions, sometimes they have a numerator problem, sometimes they have a denominator problem. Because if you're a big institution, you might have a rule that says you can only have 5% in alternative assets. And so either you got your 5% in, and your numerator is now too high, and so investors are saying, hey, I'm over allocated to the venture asset class, or you saw the denominator change, and all of a sudden they have the same investments in venture, but because their public portfolio shrunk, all of a sudden they're over allocated for venture. I think you're gonna see the same thing. Individuals, they don't have the same restrictions on what percentage of their assets they can allocate to angel investments. But certainly if you see your public equities portfolio tank, you're gonna think twice about how concentrated you want to be in crypto or your angel investments. And so yes, I think a kind of adverse market definitely impacts retail behavior, no question about it. I think that this is going to be one of those things that ebbs and flows for a while. There'll be people that come and go. That's why it might be a reason why entrepreneurs in the long run will still stick to funds that have 10-year life cycles, because depending on the crowd to be your pick up your tokens for your next stage of growth might not be as reliable as the kind of the growth equity players out there. I don't know, but I would expect that retail behavior to be more volatile than the institutional behavior.
Okay, another, or let's say final question, at least from me. Look, Kickstart is pretty much a dominant fund, certainly at the early stage in our ecosystem in the Wasatch Front. Historically, VCs have been somewhat loath to go outside their home market. I mean, there's the old rule of thumb of, you want to be able to kind of drive to a board meeting, worst case, do kind of a day flight and then day back. Where do you think that stands now? In other words, what's Kickstart doing? You mentioned in the intro, or at least RC mentioned in the intro, that you are investing throughout the Western US. I mean, are you still very much Utah focused? Do you see that as constraining your growth? Or are you also actively looking at deals, let's say in Southern Cal or the belly of the beast in Northern Cal, where there's no dearth of startup capital? And do you look at those as, let's say, leads? Do you look at those as syndicate partners? How would you look at all that?
Yeah, I mean, well, we co-invest with a lot of different groups, and so we can work with a lot of different funds, either as a lead or co-lead or follow their lead. As far as the geography is concerned, the rules of thumb, the heuristics, whatever you want to call it, in our industry changed during COVID in ways that, right before COVID hit, most VCs would have said, oh, I can't write a check into a company unless I look the entrepreneur in the eyes or something like that. Like that's the ultimate check, is being able to, build a relationship and sit face to face with them, those types of things. Where, hey, I've invested now in companies where I still haven't met the founders, and some of those companies are doing better than any companies companies where I have met the founder. And so I no longer have this belief that I have to personally meet somebody in order to have conviction of this, the founding team and the company that they're going after. So with this fund, we're primarily focused on Utah. About 50% of our investments will be in Utah, followed by probably a combination of Colorado and California. We don't explicitly say that we invest in California because there's adverse selection. If I'm seeing Bay Area startups flying out to Salt Lake City to pitch us, obviously I'm thinking, well, why didn't you raise in the Bay Area? Why am I going to be the smart one that says yes when you've already pitched to 50 funds that are as smart or smarter than I am? And so, what's my competitive advantage for getting into a great investment opportunity if you're coming from an environment that's awash in capital? And so usually the answer to that is, oh, it's because we have a really strong network connection. That's why you're coming out here. It's you grew up in this region, things like that. There are reasons why we would still make those investments, but we've made a couple investments in Southern California. We've made, 8 or 9 investments in the Bay Area. But as far as our most active markets, we think of ourselves as Rocky Mountain, Intermountain West investors. So Colorado, Utah, Colorado, Arizona, New Mexico. But I recently did an investment in a fintech company out of Atlanta. One of our unicorns is out of Austin, a fintech out of Austin called Self. We've invested in New York. So we don't say that, we won't say, well, we'd never invest outside of this region. But we have to ask ourselves always, like, why are we seeing this deal if it's out of market, and why are we smart for saying yes to it? But I do think that the old rules around, like, I mean, you all have seen what's happened to the migration of VCs and entrepreneurs out of the traditional hubs to, as they say, Silicon Valley moved to Miami, right? I think that's overstated a little bit, but the kind of restrictions on where people can invest, I think, is changing pretty quickly. And comfort with VCs investing in remote teams. It was very rare in the past for VCs to want to back a distributed remote team. They said acquirers want to buy a company where they can step into the headquarters, see the engineering team, see the culture. It's kind of like, anybody who's going to buy this company is not going to invest in a remote team. That conventional wisdom is gone now, right? Like, who out there in the VC community is telling people, like, I won't invest in your company unless you have a headquarters that I can walk into? Maybe some of them. There might be people that still believe that that's the best way to build a company. I have a partner that sees it that way, but I think that that old way is, like, gone in my view. You can invest in companies from all over the nation if you want to. You can collaborate with investors from all over the nation if you want to. You can get deal flow, and you don't have to be in. They don't have to be in your backyard for you to still have conviction about investing in the company. That's what I've seen change.
Right. Thanks.
One more question, okay? Dalton?
Yeah, sure.
I'm going to try to combine my question with Menachem's question. So in this kind of like new future where you have these pseudonymous investors and an egalitarian approach to how those decisions are made, do you think that those are going to be the areas where really early stage teams can go to get funded? Because I know that that's one of the biggest challenges, is getting funding pre-revenue, when you're just starting up. So do you think that that's going to be the place for teams? And also, with Menachem's question kind of weaved in, how would you stand out in those types of investing environments?
Yeah. So I don't know exactly, like, what the sweet spot is for these investment strategies, but my belief is that DAOs have a shot. I don't want to, maybe I'm being a little chicken by not being more definitive in what I'm going to say here, but I think there's a shot for DAOs to disrupt the pre-seed stage. And when you're dealing with a lot of opportunities to invest, and you're trying to find the green M&M in a sea of blue M&Ms, and you're colorblind, it's like, it's really hard to pick the winner. And so when you're writing small checks, and that's generally the case, like, I don't think there's a lot of differentiation in the ability to predict winners once you're at the B, C stage. Like, funds have their tools to evaluate good investment opportunities, but choosing at these earliest stages is very idiosyncratic. There's no, like, algorithm you can write to predict an outlier by definition, because the models have to update to accommodate the outlier. And so I just think that that's a category where a collective that's willing to work and screen a bunch of nascent investment opportunities is more equipped to actually make the right decision than a firm that's trying to do the same thing. So I believe that 1,000 people who have collectively formed as AI experts to invest in AI startups together will probably win the pre-seed AI opportunities more effectively than a generalist seed stage investor going forward. And so I guess if I had to make a prediction, I would say that investment collectives are poised to disrupt the earliest stages where traditional seed funds struggle to get the benefits of scale. And then the question around, like, how do you stand out? The way you stand out as an entrepreneur, I think, in any of these environments, is demonstrating that you know more about the opportunity, and you have already done the work to earn the right to innovate in that space. So, when I meet with entrepreneurs, I really don't like it when I know more about their industry than they do. Like, that's a big red flag. It's like, I'm a general seed investor. Yeah, I've been around for a little while, but why would I ever want to know more than the entrepreneur about the opportunity that they're going after? And so the way to stand out is to have already done the work to show that you understand your opportunity better, your investor. And all investors want to invest in people that are smarter than them and have a better shot at changing the world than we do as just capital allocators, basically. And so you do that by talking. You do the work to understand your customer, to understand your market, and you demonstrate that knowledge in that pitch meeting. But it can't be faked. Like, there's no such thing as like a great pitch that was like, oh, it was the pitch that got me. It was like, what a pitch, that's, yeah, you can get a second meeting based off of an incredible pitch, but to actually get funding, from an investor that's going to do due diligence and really dig in, they need to actually just have this conviction that this is a person who is going to, continue to outpace anybody else in their ability to understand their market. So yeah, demonstrating that you've talked to your customers, that you really understand their pain point, and it's not speculation, I think that sounds really obvious, but that's one way to stand out. It's like, how thoughtful is the entrepreneur, and how have they demonstrated that they've already done the work to be in a position to be the innovator in this space?
It's a great answer. And it's a great place to stop because we're almost a full 30 minutes over, but this was amazing, Dalton. I mean, I really appreciate your time, your expertise, your answers to all of these really unique questions. You clearly know what you're talking about. And honestly, I appreciated most out of your presentation, just your vision for the future. I do think that it's nice to hear that there is a future for the everyday investor, that there's a future for women and people of color, that there are, already players in that space who are doing their best to kind of like create those pathways and opportunities. And, and then maybe we won't need them because the whole system will collapse on itself when we're all just floating avatars. But thank you so much. And, everyone else on the call, thank you for staying on over. Like I mentioned before, we do have our open legal clinic next week. I will send out an email follow-up with the recording of this and also some contact information for Dalton and his LinkedIn. Thank you so much.
Sure. Yeah, happy to do it. And thank you for everybody who attended, and to you, Arcelia, for moderating.
Of course. Have a great afternoon.
You too. Bye.
Everyone.